Welcome folks to the first video on the Noob Investor. Before we get started, a small disclaimer from my side. I have not studied anything from finance in my previous entire education, or I do not have any SEBI certification. Basically, I don't have any finance background, nor have I made millions of dollars on the stock market. Who am I? I call myself a noob. Why do I call myself a noob? Even after investing for about over 10 years, I still feel there's a lot to learn in investing. And I have learned a bit, but there's still a lot more to learn, which is why I'm still a noob getting to know the field around investing. We'll start off with basics of fundamental analysis and the discussion will go on from here. And we'll see how many videos we can create out of this. So let's get started. We'll start off with the basic screener. So what is Screener? Why am I using Screener? Screener is just a website where you can see the basic stocks, their performances, their basic ratios, and how the stock, what are the balance sheets, and all such other kinds of reports that are available. You can use many other sites. All of the sites have this information. In fact, the BSE's website, the Screener pulls out its information from the BSE website itself. So there is no hard and fast rule that you have to use Screener. I use Screener because I find it much easier to use. I'm able to customize reports. I'm able to customize the ratios that I want to look at. So which is where I want to use Screener. So we'll look first at, let's say, a company, right? This is one of the most popular stocks nowadays in the Indian stock market, right? So to my fellow noobs and my friends who are there on the Zoom call with me, there are lots of numbers on the screen. When you look at this screen, which is the first number that speaks out to you? Where do your eyes go to first?
PE ratio.
PE ratio, okay. Anything else?
Market cap.
Okay, market cap. Anything else?
Share price.
Share price. Anything else? So I think for most of us, right, the first thing that our eyes will go to is the share price. Don't we want to know कि यार कल market में 5% down क्यों गया under interface, right? That's the first thing. That is how we have been trained to. That's how our eyes are. That we will first look at the price. We want to know why 5% down or 5% up stock gaya hai, right? So, but that is not what fundamental analysis is. You do not look at the price first. Price should always be the last factor that you should look at when you're thinking about investing. So today we'll look at few very simple ratios that affect how you invest: ROE and ROCE. These are very important ratios, and these are basically capital efficiency metrics, which help us understand the company in a better way, how well they are using your capital as well as any other capital that they have raised to the markets. Right. So we'll first basically start with definition of all of this. I'll first take you to the definition. So what is return on equity? Net income by shareholders' equity, right? What is ROCE? EBIT divided by total assets minus current liabilities or capital employed. Looking at this, does this look simple or complicated?
Looks simple, but definition, what does all liabilities include? What is shareholders' equity, if you can explain?
Yes, so basically what we were saying is that, yes, it looks simple because it's only one simple formula, numerator divided by denominator, but each and every part of this equation, we do not actually know, because where will you find? Kahan pe dikhega what is shareholders' equity? How total assets minus current liabilities, itna complicated cheez mein kahan se dekho, right? Yes, Screener has all of this, but Screener also calculates the final ratio together. But how we will see it is through the lens of a normal company, right? This is one typical company that I have, not a company, but a typical investment decision that I have tried to portray here. So what is equity capital? Let's say I want to start a business. I put in 1 lakh. Okay? I put 1 lakh into this company. That 1 lakh in the first year generates 1 lakh revenue. I have an EBITDA of 30%, which basically translates to EBITDA of 30,000 rupees. And tax, let's say we are tax paying citizens. And so our tax is about 9,000, which is 30%. and which gives me a net income of 21,000 rupees. So I put 1 lakh and I'm getting 21,000 in the first year itself. So what is ROE? ROE is basically this net income divided how much capital you have put, which is equity capital. So 21%. Why is ROCE much higher? ROCE is only calculated on the basis of EBITDA. It does not include interest payments and PAT. This is basically more of a capital efficiency metric only. So it is basically EBITDA divided by total capital invested. So it is 21 and 30% respectively. Is this good? So I'll open it up. Do you think 21% return on your equity or 30% ROC is good?
Yes, it is.
So why do you think it is good?
So see, if I compare with your basic instruments of investment of FD, that gives you a 7%. Even if I take good mutual funds, it will be around 15%. This is about
Right.
20%, so it is much better than both those instruments.
Got it, right? So agreed that 21% ROE on paper, like on the prima facie, looks very good because, as you said, if you invested this 1 lakh anywhere else, you will not be able to get that much return, right? So that is part one. Now, what is the difference here is that here we have taken everything as equity capital. We have not taken any loan. So now let's see how this business progresses up in the next years, right? So let's just assume that the sale is the same for the next 5 years, right? Okay. So sale has been the same for the next 5 years. Can you tell me, see what has happened here?
The ROE and the ROC ratio has dropped.
Correct. So why has the ROE ROC ratio dropped? So now what happens in a business is, let's say first year I made 21,000 rupees as profit. Now this profit is liable to be given to the equity shareholders, right? So that is why it gets added to what is called as capital reserves. So that is why now your total capital is not 1 lakh in year one. Your total capital actually is 1,21,000. And on 1,21,000, you are still only getting 21,000 rupees. So basically, this is what is effect of compounding. So what is happening here is that you're not able to compound your earnings, right? So in year 5, I have 84,000 rupees in capital reserves. So that is where of 1,84,000, only 11% I'm getting return, right? So that means this is, for me, ROE is also a compounding metric. So this is another important factor when you look at a company, whether your amount is getting compounded or not. Here, why is it not getting compounded? Can anybody can we have a discussion what can be done here where we can improve our ratios?
The revenue needs to increase.
Yes, so there should be sales growth, correct? Sales growth is one of the most important parts. But let's say we are not doing sales growth. Our business is such that there is not a lot of growth in business. So what can we do then?
Profit should not be then, like if you are this PAT of first year you are using in second year and you are still generating same profit, then your return is less. So either you take out those 21,000 and use it.
Right. So basically what you are saying is pay dividend. Right? Yeah. So what we are saying is because we are not able to grow the sales more in the next year, what we will do is we will pay off dividend. Right? Let's say we make this 100%. Right? Now, if we pay off each and every year, so what we are doing is we are keeping all the ratios same. And what we are telling the investor is I have generated simple interest for you. Here is the simple interest. This 21,000, I give it back to you. You invest it somewhere else where you can get it compounded. I cannot compound the business for you, right? But if you see now, like in the end, the business has earned 84,000 plus 21,000, which is 1,05,000 in 5 years. In this case, that money is still within business. In the dividend payout case, the money is with the shareholders, Which is a better form of doing business?
If you are able to compound, grow the money, then you can keep it within the company also.
Yes, correct. So that is the ideal case where if you are able, the reason you do not pay dividends and keep the money in this thing is you can use that capital to grow revenue, right? So that is a very important part of growth. But like I said, for now, we will consider that there is no growth.
So if you give dividends, you're communicating to your shareholders that you have a strong cash flow and that you're reliable and a good investment for long term, right?
That is not necessary. So like we are saying here, the actual reason for paying dividend here is कि मैं growth नहीं कर पा रहा.
Okay.
I am not able to compound your money, so I'm giving the money back to you because I'm not compounding. So we need to understand the reason why dividend is being paid. In this case, the dividend is being paid because I'm not able to compound your money. I'm not able to use the profit that I've made and reinvest in the business.
Understood.
So, okay, we'll come back to this. Let us see a real life example for this. Okay. I will take one of the biggest companies of the Indian market, Reliance Industries. They have a ROE and ROCE of how much? 9%, 10%. So what does this mean? This means that they are not able to make enough money, they are making less money than what if they had invested in the stock market. Right? So is it a good thing or bad thing?
Bad thing.
Bad things.
Yes. Yes, it's bad thing. So what we are basically saying is कि जो पैसा है Reliance के पास, they should remove that and invest it in the stock market. But there's a catch there. Okay. The reason why Reliance has such low ratios is you come to the balance sheet and look at the reserves. They have 8 lakh crore as reserves. Means they have 8 lakh crore as cash on their balance sheet. So it is this heavy cash component which is there in the business, which is reducing the ratios, which is similar to what we saw here. इतना cash पड़ा है, इसलिए मेरे ratios कम है. Right? Now we will come to the other example where we have dividends. Right? Okay.
Vinod, one question. Why would company keep this? I mean, and not give dividends?
So Reliance is a very unique company in that case. That you, in general, if you see Reliance dividend payouts, it has been 10%, 11%, 10%. They don't pay out dividend. Reason being is they still believe that in future they will be able to invest this money and generate growth out of it. So, and there is another reason also is that they want controlling stake, retain controlling stake in the company. So that is another whole discussion also. But basically, they still believe that this money, which is their 8 lakh crores, they can use to generate more money in the future, which is why they are investing into new businesses. Right? So now coming to the next example, which is Nestle, another very big company. Right? But here you see what is the big difference. Look at the ROE and ROCE. It is absolutely out, like off the charts. And you see how they have been able to maintain the ROE ROCE is because they pay out 80% of the dividend as dividend. 80% of the profits that they generate, they're giving back to the shareholders. Now let's look at another FMCG company, ITC. What do you see in ITC? ITC also much higher ROE ROCE, right? And they are also paying 84% dividend. Correct. So the reason I'm showing you these companies is that while they are not growing at very high rates, like if you see ITC sales growth over 3 years is only 13%, and EPS growth is only 15%, even though they are not able to generate as much growth, their ROEs are kept very high because they are paying out 84% of their profit. Correct. Now, if you see, this is a very clear example in, let's say, in a Nestle. I'll take you to the balance sheet. Right. If you see their cash holdings has not increased since 2013 much. To 2,200 crore se 3,900 crore. That's all. In fact, their cash holdings reduced in 2020 and 2019. Here they must have paid out much higher dividend. So again, what basically this company is telling you is, we are able to generate good returns for you in a single year, but we do not have the right investment opportunity to reinvest this money somewhere in our business where your actual earnings can increase. So that is how we need to look at a company for ROE and ROCE. Now, you also must have noticed that for Nestle and ITC, the ROEs are much higher than, let's say, for a Reliance or even the example that we took. Now, why do you think that these companies have such high ROEs and ROCEs? The reason is they are big brand names and hence their EBITDA percentages are much higher. So let's say I make this 70% EBITDA, my ROE, ROCE increases rapidly. So when you have higher operating margins, you have a higher ROE and ROCE. So this is another important thing, that bigger brands, they are able to generate a lot more ROE and ROCE because they have higher EBITDAs. You cannot have companies which are at low ROE, ROCE. Sorry, you cannot have companies with low EBITDA. Like let's say it's a B2B company. Its EBITDA percentage will be about 10 to 15%. Generally, उससे ज़्यादा होता नहीं. So they will always have ROE and ROCE lesser compared to, let's say, a big brand like an HUL or a Nestle, who have much higher ROE and ROCEs. So this is another factor which impacts ROE and ROCE. So this concludes my basic discussion about ROE and ROCE. There's one other impact of ROE and on ROCE is, let's say, instead of putting 1 lakh as capital, I take 50,000 loan and I put only 50,000. Did you see what happened? My ROE increased a lot, basically doubled, right? Because I'm generating the same profit at much lower investment capital of only 50,000. So this is another way which businesses can conduct, is they take loan. Because loan interest is only, let's say, it is slightly lower. Let's say it's a 10% interest. Still my ROE is 35%. So this is the reason companies take loan, is they are confident that they are able to generate more margins than what the interest rate is. So 10% है, 10% से ज़्यादा तो मैं generate कर ही रहा हूँ. So this improves the shareholder value much more when you're able to take loan and generate better returns. So this is another part that which we should consider. ROCE, if you see, ROCE remained the same because total capital is 1 lakh only. But ROE increased because shareholder value is much lesser. मैंने पैसा कम डाला. Right? So this is another part which is important with regards to ROE and ROCE. Now we will come to what we'll say as, which we already talked about, where we said that companies should grow. When you are generating profit, for the compounding effect to take, the company has to compound, it needs to keep growing, right? So let's just say this company has let's just take, for simpler sake, just take 3 years, has a 20% growth, right? So if you see here, the ratios have not dropped at all. You can see the impact of growth. That growth, if your growth is good enough, your ratios will not come down. And that basically means that you're still compounding the shareholder money. So now comes the important question, that where should I invest my money? In high ROE, high ROCE, high growth, low growth, what should I invest in? So before we get there, typically, let us say an old company which we looked at, like a Reliance or a Nestle or this, these guys have stable and lower growth, right? Compared to, let's say, a new age company. New age company is trying to expand a lot, so they have, or a smaller company. Why do people want to invest in small caps? Is because their sales growth is much faster than a large cap, because their base itself is small, right? let us say a company is in a growth phase or an early stage company. What do you think their ROE and ROCE will be?
It would be low, no?
Yes, it will be low. Why is it low? Because they need to invest capital, they need to invest more in marketing and a lot of other things in order to gain market share and actually grow. Right? So what happens is, I'll give you an example. Like one of the favorite industries right now is EMS, electronic manufacturing services, right? These are fast growing companies. You look at one such example. See, Sirma SGS, sales growth 52% compounded over the last 3 years. What is the ROE? Just 6-7%. Right? Because they're growing. So for them to grow, we cannot expect such companies to have high returns. These companies will give you returns later on because capital has to be invested upfront. So let's say they want to have a capacity of 1 lakh units. They will build a capacity of 1 lakh units, but initially demand might be only of 20,000 units. In 3 years, the capacity will reach 1 lakh units. That is when you will start seeing that ROE is actually growing. So typically, high growth will be accompanied by low ROE, ROC. Right? So this is something which we look at. Now, can there be a case of both high growth and high ROE?
If profit margin is very high.
For a software company, which doesn't need like a platform, it can have.
Right. So even for a software company, if they need higher growth, they still need to invest in some kind of infrastructure. So cloud infrastructure, which is there, they still have to invest in that. Everything is not at use basis, right? So even for a software company, yes, I agree that there will be a few cases of that. But for me, right, if I see a company which is high growth and high ROE, it rings alarm bells. Why does it ring alarm bells? Is that either it is a one-off case कि ये साल में ये हो गया इसलिए high ROE high growth है, afterwards it will not sustain for long. Second, it could be the case that it is too good to be true, or that everybody will get into the business. See, कोई भी company, if they are starting a business, they need to have a moat, right? Now, if a company is going high growth, high ROE both, then there'll be 1,000 other people lining up to start a similar company. And once similar companies come out, automatically their growth and their ROEs will start falling off. And of course, the other part is people are fudging books, but we'll not get into that. That is something which is completely, we cannot really look into all of that. But for me, high growth and high ROE are warning signs, which might, you see this, if you see the company, this is 300% growth with 90% ROE. Right? So for me, this stock has done very well. People have invested a lot into this stock. This is a very popular stock for everybody. But for me, it rings alarm bells. Either this is not sustainable, one, or second, everybody is going to get into this. And I think that is what is happening. That everybody now wants to get into renewable. Everyone wants to get into green. Because it is for normal businesses to grow, you need to initially sacrifice and get capital invested and have a phase of low ROE. Only then is the growth sustainable, and you will not have competition as well. So for a long-term investor, such kind of companies ring alarm bells for me, which is why this is something, again, my opinion, this is not something which everybody needs to follow. So the thing about investing in markets is there are 1,000 different opinions, and 1,000 different opinions form the market, which is why you will have buyers and sellers on everything. Because if everybody had the same opinion, everybody would want to buy the same stock and everybody would want to sell the same stock, which is not possible, right? So this is my framework, which I like to use. So this is just a simple matrix, right? So high ROE and low growth, these are basically kind of safe havens, like your FMCG companies, which I showed you. Even if you look at, let's say, TCS, very high ROE, right? But lower growth, 10% growth, which is not really that sustainable, which is why they are paying out 60% as dividend. And not only they pay out dividend, TCS also does buyback through whatever profits they have generated. So these are kind of safe havens for me. Low ROE, low growth is something which is completely something which we should avoid. is what I feel. And that is, I think, pretty simple, that you're not compounding my money also, you're not growing also. So how will I make money ever? High ROE, high growth, as I said, it rings alarm bells for me. Low ROE and high growth is what we talked about with the example of EMS industry, is where we can do growth investing. Right? So growth investing is something which a lot of people do, and especially in small caps and mid caps. And this is where a lot of return can be made. But there is a safer and middle way to do it as well, which is this kind of green blob that you see here. This one is where we take a middle route of everything. Not extremely high ROE, not extremely high growth. Somewhere in the middle. It is what some people call as consistent compounders. Right? So I will try to, so this is another reason why I like Screener a lot, where you can create a screen very simply. It's very easy to create a screen on Screener. Just go to screens, add, create new screen. So what I'll say, so what is middle of the road? So for me, something like a 20-25% or up to 30% ROE is in middle. Anything above 40-50 is high. Same for growth. Anything below 15% is low growth. Anything above 40% is high growth. 20-30% growth is middle of the pack. Even, in fact, even Warren Buffett says that look for a company which gives you ROE, ROCE of 20%. That will keep you good for the rest of your life. These are companies which you can hold for a long time. So if you look at this query, which I'm writing, basically what I'm saying is my return on equity for the last 3 years should be above 20. Return on capital employed also should be above 20. Sales growth should be above 20 for last 5 years. And I want market cap above 5,000, because I am not that well versed to understand much smaller companies, because much smaller companies, it is much easier to get these metrics. So I want a little more safety. So I want more than 5,000 crore market cap for the company. Okay. If you see, there are total 53 companies which fit this bill. Right. And most of these companies which we already know, right? Titan is an all-time favorite for most Indian investors. And if you see their ratios, ROE of 30%, ROCE of 22%, growth of excellent growth of 33%, and even 20% over 5 years. So, and this is not just for, let's say, for past 5 years. This company has been compounding shareholders' wealth for 20 years. You see this. Sales growth over 10 years is also close to 20%. Stock price CAGR is 23% over the past 10 years. 23% CAGR for 10 years means your money has pretty much become like 10 times in 10 years. You want such companies, right? 10 गुना हो गया 10 साल में और क्या चाहिए? So this is one of the companies. There are lots of, like, of course, now this doesn't mean that every one of these 53 companies is what I want to invest in. You need to do further analysis, but this is a very good starting point of understanding that which companies are actually good. There are a lot of limitations to such kind of investing. There'll be a lot of companies which you will miss, but these are what I call pretty safe, not high risk investments, where you can compound your money on a year-on-year basis. There, I will talk about a few limitations. One of these limitations is because I am putting ROCE also as a factor, banks will be missed in this. Banks have different valuation metrics, which we can cover, which I will cover in a separate video. Other companies which I will miss, that which we talked about earlier, is high growth companies. Correct. And other companies which that will be missed is, let's say somebody has 19% or 18%. That is also still good. So you need to kind of drill down a little bit. And then for each of these companies, there is no blind investing. You need to go read about the company. Let's say a typical company. Let me take KPIT. Okay. They have shown very good numbers. They have sales growth of 33%. They have ROE also of 30%. Their dividend payout is also not very high, so they are reinvesting their money. 30% is typically, which is pretty reasonable in terms of a dividend payout. So they are reinvesting their money also. So is it a good company to invest in? So what determines whether it's a good company to invest in is understanding whether this company will actually maintain or sustain this growth for next 3-5 years. So that is the final study that one needs to do before investing into a company. So typically, that is the kind of analysis what I do to invest my money. Some part of my money is parked into such kind of companies, which I call as the 20-20-20 companies. 20% ROE, 20% ROCE, and 20% growth. Right. So I think that is all that I wanted to speak about for this video. Thanks everyone for tuning in. This was the first part of a fundamental analysis series that I'm trying to start on the Noob Investor. Stay investing, and a happy Diwali to all of you. Thank you.